If you think silver is still the boring metal sitting in a drawer, you are already late to the real story. What changed is not just the price of silver. What changed is the structure underneath it. And when the structure changes quietly, while the crowd is staring at technology stocks, the Federal Reserve, elections, wars, or whatever noise happen to dominate the last headline. That is usually where the most important money gets made. I learned a long time ago that the market does not reward the person who reacts fastest to noise. It rewards the person who notices the thing that changed before the crowd realizes that anything changed at all. That is why I want to talk to you about silver. But I want to be very clear from the beginning. This is not really a story about silver alone. It is a story about how rules, ratios, regulation, and physical scarcity can quietly change the relationship between one asset and the stock market. And if you own stocks, index funds, a retirement account, or precious metals, this matters to you whether you know it or not. The first place I always like to start is not with a headline and not with a prediction. It is with a ratio. Prices by themselves can lie to you. A stock can go up because the dollar is weaker. Gold can go up because fear is rising. Silver can go up because somebody on television is shouting into a camera. Prices contain noise. Ratios remove some of that noise. The ratio I care about here is silver divided by the S&P 500. In plain English, that means one simple question: how expensive is silver compared with the American stock market? When the number is high, silver is expensive relative to stocks. When the number is low, silver is cheap relative to stocks. That sounds too simple for most people, which is exactly why it works. Most fortunes are not built by doing complicated things. They are built by noticing simple things that other people keep ignoring. Now here's what matters. Over the last half century, this silver to stocks ratio has only hit a handful of extreme lows, and every time it reached those deep lows, silver later made violent multi-year moves higher relative to stocks. Not every month, not every quarter, but when the ratio became truly stretched. The move that followed was not subtle. In 1980, silver exploded relative to the stock market. In 2011, silver exploded again relative to the stock market. And in the smaller lows in between, the pattern remained the same. When silver got deeply, embarrassingly, almost absurdly cheap compared to stocks, the setup for a major reversal was already in place. That does not mean the move happened the next morning. It does not mean there were no painful drawdowns. It does not mean anybody had a guaranteed outcome. What it means is that valuation extremes between assets matter. If one asset gets hated enough and neglected enough while the structural conditions underneath it are quietly improving, that is where asymmetry appears. And right now, silver sits near one of the cheapest levels it has seen in the modern era relative to the stock market. That is not an opinion. That is not a sales pitch. That is data. Now, if that was the whole story, it would already be interesting, but it is not the whole story. A cheap ratio by itself is only the beginning. Cheap things can stay cheap for a long time if nothing underneath them changes. The real question is this: did something underneath silver change? Yes. And that is where the story gets serious. For years, the silver market was allowed to function with a giant layer of paper sitting on top of the real metal. Most ordinary investors never think about this because they imagine silver as bars, coins, jewelry, silverware, or perhaps mining stocks. But the market that sets price is full of promises, contracts, and claims on silver that are not the same thing as a specific bar with your name on it sitting in a vault. That distinction matters more than most people realize. Banks and large institutions were able to hold enormous books of what is effectively paper silver, unallocated silver claims, promises, exposure without the same burden of holding actual allocated metal in the old-fashioned sense. Then the rulebook changed. A quiet regulatory shift began to make that old game more expensive. The piece of the change that matters most here came through Basel III and, more specifically, the net stable funding ratio. I know that phrase sounds like something invented to help people fall asleep in a compliance meeting, but sometimes the boring language hides the most important changes. What it means in practice is that holding unallocated precious metals exposure became more capital-intensive for banks. Put even more plainly, a business model that used to be easy and profitable suddenly became more expensive to carry. And when something becomes more expensive for a bank, the bank does not absorb that pain out of kindness. It changes behavior. That is the part ordinary investors miss. They focus on the headline price of silver. I focus on whether the infrastructure that determines silver pricing is being quietly pushed away from paper promises and toward real physical metal. Because once that push starts, the floor underneath the market changes. It does not happen with fireworks. It does not arrive with a dramatic speech. It arrives through higher costs, tighter rules, less willingness to warehouse paper exposure, and a gradual migration toward actual metal. This is how financial systems change, not with a trumpet, but with a footnote. And if that were the only shift, it would still matter. But it was not the only shift. China made the second move. For a quarter of a century, silver exports from China operated under one framework. Then that framework tightened. Export control became more restrictive, licensing became tighter, access became narrower. Again, most regular investors never saw this as a major event because it did not arrive with some giant red graphic on financial television. But you do not need television to tell you what matters. If you understand the role China plays in refined silver, China is not a side character in this story. It is one of the central characters when a country that plays such a significant role in refining, processing, and moving silver begins tightening the pipe. You do not need to be a genius to understand the consequence. The rest of the world has to compete harder for the same ounces. That matters because silver is not merely a monetary metal sitting around waiting to become fashionable again. Silver is an industrial commodity in a world that suddenly wants more electricity, more solar panels, more electric vehicles, more data centers, more advanced electronics, more medical equipment, more transmission infrastructure, more AI hardware, more everything that requires conductivity. Gold can sit in a vault and do nothing. Silver does not get that luxury. Silver gets used up, pulled through manufacturing chains, embedded in systems, and dispersed into places where recovery is difficult and sometimes uneconomic. That is what makes this setup so unusual. Silver is wearing two hats at the same time. It is an industrial input and a monetary refuge. That dual nature is exactly why it can move so violently when supply gets tight and capital begins to notice. Now let me make this more concrete. The solar industry alone consumes an enormous portion of annual silver supply. Electric vehicles use more silver than conventional internal combustion vehicles. Data centers, especially as the world rushes into AI infrastructure, need electrical systems that do not function on wishful thinking. If you want reliable, fast, efficient conductivity, silver stays in the conversation. That means you do not need some apocalyptic scenario for silver demand to matter. You simply need modern industry to keep doing what it is already doing. And if industry is already leaning harder on silver while the financial plumbing is being quietly forced toward physical discipline, the setup starts to become obvious. Then we get to another part of the story most people do not watch closely enough. Inventories. When people speak casually about silver, they often assume there is always plenty of it around because silver is common enough to be familiar. Familiarity creates false comfort. People assume that because something is known, it is abundant in the right place, at the right time, in the right form, at the right price. That assumption breaks down quickly in real commodity markets. What matters is not whether silver exists somewhere in the world. What matters is whether the available, deliverable, usable stock is getting tighter relative to immediate demand. And when I look at warehouse drawdowns, exchange inventories, and physical flows, I do not see comfort. I see tightening. I see pressure. I see a market where the visible stockpiles are not infinite, where industrial demand is not taking a holiday, where financial reclassification matters, and where a country as large as China has every incentive to secure what it needs before the rest of the world wakes up. That is how shortages sneak up on people, not because nobody knew the metal existed, but because everybody assumed somebody else had already solved the problem. Now, there is another important psychological piece to this story, and it is one Buffett learned to respect long before most people ever thought of me as an investor. Markets love what is already working. They love what just made people money. They hate what feels dormant, embarrassing, old-fashioned, or early. That is why silver being boring for years is not an argument against it. In many cases, it is the reason the setup exists in the first place. By the time the average person becomes excited about an asset, the easy money is usually gone. What I care about is not excitement. I care about dislocation. I care about moments when the crowd is still arguing about yesterday while the rule book under tomorrow has already changed. Silver has that smell right now. Not certainty, not guarantee, but dislocation. And when I see dislocation, I do not ask whether the crowd is excited yet. I ask whether the conditions are moving in my favor before the crowd can price them in. This is where I want to give you the simple framework that matters most, because people lose fortunes when they rely on stories without a checklist. I never liked gambling. I liked edges. And an edge only becomes useful when you can describe it clearly enough to act on it with discipline. So if I were building a practical silver framework, I would reduce it to 3 signals. The first signal is the ratio between silver and the S&P 500. This is the compass. When silver is expensive relative to stocks, your risk-reward changes. When silver is historically cheap relative to stocks, your risk-reward changes the other way. You do not need to predict the exact top or bottom. You need to know whether you are near a zone where history says the asymmetry has improved. Right now, silver looks historically cheap relative to the stock market. That does not mean it rises tomorrow. It means the setup is not something a rational person should ignore. The second signal is the physical supply-demand balance. This is the hard reality test. If the world is consuming more silver than it is producing, if deficits are recurring, if inventories are being drawn down, if industrial demand keeps expanding, that is not a poetic story, that is arithmetic. Markets can ignore arithmetic for a while. They cannot ignore it forever. When deficits persist year after year, you are not looking at a one-off inconvenience. You are looking at structural tightening. And structural tightening matters most in markets where people got comfortable with the old abundance narrative. The third signal is the rule book itself. This is where the largest misunderstandings live. When regulators make paper more expensive, when governments classify a metal as critical, when major countries tighten export pathways, when the system quietly begins rewarding physical possession more than paper abstraction, those changes matter before they are reflected cleanly in price. That is the whole point. The crowd thinks price is the signal. Often the real signal comes before price. It comes in the rules. Now, I also want to be honest in the way that actually matters. Silver is not a toy. It is not a straight line. It is not a magic ticket. And it is certainly not appropriate to treat it like some all-in, back the truck up, bet your future fantasy. One of the reasons silver creates extraordinary upside in certain moments is that it is volatile enough to be deeply painful in the wrong hands. The same metal that can move fast in your favor can just as easily punish undisciplined people on the way down. If you cannot handle sharp drawdowns, if you need daily emotional reassurance, if you confuse volatility with betrayal, silver will teach you painful lessons. That is why the way you size an idea matters just as much as the idea itself. I never built my fortune by falling in love with one outcome. I built it by respecting probabilities, staying within my circle of competence, and refusing to let excitement replace judgment. If silver belongs in a portfolio, it belongs there because the structure justifies the position, not because the story feels thrilling. And this is where I want to bring the whole thing together. This silver story is not about whether I can give you an exact target price. It is not about whether next month will be spectacular. It is not about television drama or internet certainty. It is about whether the foundations underneath the market have shifted enough that a neglected asset now deserves serious attention. I believe they have. Silver is historically cheap relative to the stock market. The paper system around it has become more expensive for large institutions to run in the old way. China has tightened part of the export pathway. Industrial demand remains real and growing. Visible inventories are not a reason for complacency. And the market still largely behaves as if silver were an afterthought. That combination is rare. When rare combinations show up, I pay attention. Not because I know exactly when the market will wake up, but because I know that once a market wakes up to a structural shift, it usually moves faster than the average person believes possible. That is how money is made in waves. First, nothing happens. Then the story sounds silly. Then the people who noticed early look wrong. Then the system tightens a little more. Then capital slowly rotates. Then one day the asset is no longer boring, and everyone starts asking why nobody told them sooner. By then, the price has already done the talking. If I were looking at silver from the position of a 60-year-old, a 70-year-old, or any serious investor trying to preserve purchasing power while still maintaining some exposure to asymmetry, I would not ask whether silver is trendy. I would ask whether I understand the role it plays. I would ask whether I understand the risks. I would ask whether the position fits inside a broader plan. And then I would act accordingly, calmly, without drama, without the need to be entertained by my own portfolio. That is how adults invest. You do not need to scream at the market. You need to understand it. And right now, the silver market is whispering something important. It is whispering that the rules have changed. It is whispering that the ratio is stretched. It is whispering that physical reality matters again. And the people who ignore quiet whispers usually end up reacting to loud prices. By then the opportunity is different. By then the pain of inaction is often larger than the pain of volatility. So here is the final test, not whether silver doubles this year, not whether somebody on the internet gives you a perfect entry, not whether the story becomes popular. The real test is whether you can recognize a structural change before the crowd demands proof in giant letters, because that is where intelligent investing begins. You are not being asked to gamble. You are being asked to notice. You are being asked to compare the ratio, study the deficit, respect the rule change, and decide whether reality is shifting faster than the crowd's understanding of it. That is all. But in investing, that is often more than enough. If I had to reduce this entire story to one sentence, it would be this. Silver is no longer just a sleepy metal with an old reputation. It is becoming the meeting point between industrial necessity, monetary distrust, and regulatory change when three powerful forces start pulling on the same asset at once. The smartest thing you can do is stop laughing at it and start reading the rule book. Because the people who understand the rule book rarely need to chase the crowd, and the crowd rarely gets invited early. In markets, late attention is expensive. Early understanding is where the real edge lives. That is the edge I want you to remember. Not the noise, not the drama, the edge. And once you see it, you cannot unsee it. There is one more piece I do not want you to miss, and that is the difference between being right and being positioned correctly. A lot of investors spend their lives trying to win arguments. They want to be the first person at dinner to explain why an asset is undervalued. They want the emotional reward of being early, but markets do not pay you for being verbally correct. They pay you for being positioned with enough discipline to survive the path between being early and being proven right. Silver is a perfect teacher of that lesson, because even if the structure is improving, even if the ratio is attractive, even if the industrial demand is real, silver can still scare people out of good positions with sharp reversals, ugly pullbacks, and long stretches where nothing seems to happen. That is why the people who benefit from these setups are usually not the loudest believers. They are the most prepared owners. They understand what they hold. They understand why they hold it. They understand what would make them change their mind. And they do not confuse temporary noise with permanent impairment. I have seen the same principle play out in stocks, bonds, arbitrage deals, insurance companies, and entire market cycles. The crowd almost always wants emotional comfort before it wants exposure. It wants a green chart, a social consensus, and a reassuring headline. But by the time all three arrive, the compensation for taking the risk is usually much smaller. The other thing that matters here is the exchange mechanism itself. When people hear that inventories are tight, they often imagine some movie scene where the world simply runs out of silver overnight and the chart goes straight up. Real markets are messier than that. What actually happens is that stress shows up first in spreads, premiums, delivery pressure, unusual flows, and the widening gap between paper assumptions and physical urgency. That is how a real market tells you the old equilibrium is weakening. It does not always scream first. Sometimes it just stops behaving normally. And when a market stops behaving normally while the official story still sounds calm, that is when I pay the closest attention. So if you want the cleanest way to think about this from here, it is very simple. If the ratio remains historically cheap, if the physical balance remains tight, and if the rule changes continue rewarding the real metal over the paper version of it, then the case for silver stays alive, whether the crowd applauds or not. If one of those pillars breaks, you reassess. That is what a serious investor does. Not worship, not panic, not marry the story, reassess. In my experience, that habit alone separates people who build wealth from people who keep renting conviction from strangers. And this silver setup, more than most, rewards the person who can think in probabilities instead of emotions. That is why I keep coming back to the same final point. The quiet rule change is the story. The cheap ratio is the invitation. The tightening physical market is the confirmation. And your behavior in response to those three things is what determines whether this becomes an opportunity in your life or just another chart you end up staring at after the move is already gone.